my name is Michael Marinovich. I'm a vice president in IHS Markit's Upstream business line, and I'm going to be facilitating a brief conversation with three of my colleagues across the upstream business about key issues that we see for the upstream industry in 2021. So I'll let them introduce themselves. Lyle?
Yes, I'm Lyle Brinker. I'm executive director in the Companies and Transactions Research Service, and I'm responsible for the coverage of the integrated oils, international oils, and the publicly traded national oil companies.
Miriam.
Thanks. I'm Miriam Alshama. I'm a director in the E&P terms and above ground risk team, where I mostly focus on the latter part of that, above ground risk for the Middle East.
And David.
Yeah, hi, Michael. Thanks so much for having me, and thanks to the audience for taking your time to listen to us today. I'm David Boucher. I work in the Upstream Cost and Technology Group, focusing primarily on field service operations.
Okay. Well, with just a bit of context, with the COVID-19 pandemic intensifying pressure on the industry, companies or E&P companies and service companies are finding it more and more difficult to get financing because of their financial performance, as well as growing concerns about greenhouse gas emissions. And in turn, the host governments are facing increased competition to secure diminished capital. And so given that, our view is that the choices that each stakeholder, each of the individual governments and companies take over the next couple of years are going to have a very big impact on their success, their long-term success. So Lyle, why don't you speak a little bit about some of the challenges that the companies are facing right now?
Sure. Yeah. Thanks, Michael. Yes, we're coming off a year, of course, we're all aware, was very challenging for the entire global economy, but particularly for the energy industry and for the global oil and gas industry. We've seen both prices whipsawing and margins contracting and demand contracting, which caused the downstream segment of the business to also suffer losses in many cases. So with the rebound in oil prices in recent weeks and recent months, there has been some additional recovery in terms of sentiment, but overall, the industry still faces some serious challenges. Balance sheets, after significant cash flow deficits last year, balance sheets are now much more leveraged than they have been in any time in the past several decades, and that's for the industry in general. Overall, investor sentiment remains quite low, and in fact, the weighting of the S&P Energy Index complex fell to about 2% at the end of 2020, which compares to about 4% the prior year and about 11%, say, 7 years ago. So investors are still very concerned that the industry itself is not earning a significant or worthwhile returns on its investments. It faces significant challenges, of course, as you mentioned, with the energy transition and the uncertain outlook for demand going forward for traditional oil and gas operations. And all these things are causing investors to rethink, and it's going to be difficult, I think, to get the attention back in many cases, given other parts of the market are still doing pretty well. But spending overall, the outlook for capital spending this year is probably about flat with last year. Companies are certainly focusing on their best projects and their lowest break-even cost types of projects, which is more of a challenge if you're outside of the low-cost regions of, say, the Middle East and some other areas. Looking towards the M&A market, M&A market was very much depressed for most of last year. We did see a pickup in M&A activity and consolidation activity in the second half of last year, with a lot of E&P companies merging in the U.S. especially. But the asset market remains quite weak and quite slow. But we do expect that M&A activity will start to pick up and recover this year because oil prices have recovered. They appear to be at least more stable in this current $50 to $60 range right now, which is what appears to be the area that OPEC is defending at this point. Of course, a lot will depend on the path of the pandemic in the coming year and demand outlook. But nonetheless, that that stability and that recovery in prices should help investors become more confident. We do think that more consolidation is necessary in the industry for the industry to both high grade their portfolios, improve their balance sheets, and reach the scale that they can also reduce costs, because that's going to be very important going forward, is controlling your costs. So thus far, even with the recovery in oil prices, most companies are still maintaining capital discipline. We haven't seen a whole lot of increases in spending and capital budgets this year, and we would expect that overall spending is likely to be about flat to slightly higher, depending on the region. But that's for this year. With the recovery of oil prices in subsequent years, if it does materialize, then the companies should be able to divert excess free cash flow to reduce debt and improve the balance sheets, and that should help improve investor sentiment to some degree.
Okay. Well, David, any other thoughts about that?
Yeah, no, thanks so much, Lyle, for that really thorough summary. I think the one point maybe I would add is regarding ESG, because that is something that we hear a lot talked about. But then when you talk about, okay, where are the dollars behind this, I think that's where it becomes more nebulous. And I think from my point of view, as someone that's looking at kind of the operator service company interaction, there's a couple of different dimensions that we want to think about. The first one is that when we talk about ESG, there's two ways to look at it. There's just at a very high level, and then there's, okay, like rubber meeting the road, how do we actually measure and track this? So when you talk about measurement and tracking, you're basically talking about systems, processes, and tools to implement. That's going to be very difficult. It's going to be very complex, and it's going to be costly. And that only becomes more difficult when you think that it's not just about the operator's performance within their kind of office and field locations. You have to also bring in the service companies. So if I'm an operator hiring a service company, clearly the service companies that I hire have to buy into my way of measuring ESG. They have to be plugged into my system so I can capture their performance. And then I have to roll that up in a way that's comparable to all my other operator peers. So I had trouble just saying that. So imagine implementing it and then paying for it. It becomes very difficult, especially in a capital intensive environment, a capital constrained environment like what Lyle was describing. I think the second point I would say on that is that, service companies clearly have certain core strengths. And so when you look at, again, the operator side, if they say, okay, we're serious about ESG and hitting these goals, then you're looking at your supply chain and saying, well, okay, this particular service company has bought into this. They're trying to make that transition, so they're going to stick around. This other service company I worked with before, not so much. So we're going to ask them to maybe step aside. And then, hey, there's these other startups that are offering these new products and services. Maybe we want to give them a shot as well. So working through this exercise of saying, right, these are my ESG targets. Now, what's the best possible team I can put together to make that happen? That's a challenge in and of itself. And then further optimizing that mix of suppliers. So in the same way that operators have their go-tos now and they're optimized, that needs to happen again to reach these ESG targets. So from a nuts and bolts perspective, it's very difficult. But then if you say, what's the motivation behind all that? I think, Michael, you're going to ask me to turn it over to Miriam now, because
Yes.
she will actually give us a view on what's actually driving this, right? Because it is going to cost money. So what, from a high level, is going to cause these operators and service companies to fall behind this?
Sure. I mean, let's turn to the governors of the hydrocarbon resources, and how are the governments going to respond given this environment of constrained demand and increasing demands on the nature of the hydrocarbon and the cleanliness of the hydrocarbon produced.
Sure. Yeah. I mean, it's really a mixed picture, which, you might expect, given there are a lot of factors that go into each government's decision-making process, like the structure of the economy, the role of the oil and gas sector within that, the level of civil society activism and the demands placed on the government, as well as just the plain old capacity of government to make policy and implement it. So we see a wide range here. If you look at some of the large producers that are oil dependent, that really rely on the oil and gas industry to generate revenues and drive economic growth more broadly, they are really extremely interested in continuing to attract investment or attracting new investment. And in some of those jurisdictions, we do expect they'll adopt more regulatory or procedural flexibility. Some of the moves that they made in response to COVID, like moving to online licensing, we expect those to continue. A move to more permanent offering or open door licensing and direct negotiations instead of your traditional bid rounds in an effort to get investors in on a more continual basis. That's something we've already seen to some extent in Colombia, Egypt, Oman. Moves to make fiscal and contractual terms more attractive are also possible, but those have to be balanced against the government's own financial needs. So those tend to be slower, and they tend to, I think they will be more incremental. And then if you move on to another group, also oil dependent, but with a lot more financial power, and I'm thinking of the Gulf states here, primarily Saudi Arabia, UAE, Qatar. They're really focused on extending the life of the hydrocarbon industry. So lowering the carbon footprint of oil and gas operations so that they can be producing longer. And really, it's the NOCs that are driving some of the moves in these countries, investing in CCS and other technologies that they think will allow them to achieve these aims. And in some cases, so UAE and Qatar, they're actually doing that at the same time that they're trying to accelerate or bring forward the monetization of their remaining resources. So, higher near-term production targets that will allow them to extract value now instead of waiting to the long term when you don't really know what the value of that resource will be. And one final group of countries I just wanted to mention are those that have important hydrocarbon industries, but also have really ambitious greenhouse gas emissions reduction targets. So thinking UK, Norway, they're trying to find ways to support industry while also moving towards hitting those targets. So we're likely to see that industry support increasingly coupled with stringent environmental and regulatory moves, incentives to invest in lower carbon technologies. They've invested a lot of money in trying to build up their carbon sequestration capture industries in a way that they hope will grow alongside the hydrocarbon industry in those places. So as you can see, there's a real diversity of government actions, and I think we're going to continue to see that. I won't say it's not a binary divergence, but it's really a lot of different paths that companies and countries seem to be on at the moment.
Yeah, no, also with the companies and different players making different having different views about how important it is to reduce, change portfolios, potentially invest in new in cleaner technologies, but also you mentioned with the carbon sequestration, which for countries with large service sectors, that could be quite an important element for supporting the industry while at the same time reducing emissions. And David, do you have any other comments about the supply chain and how the supply chain is going to be affected?
Yeah, so I don't think I'm wrong in saying that we've made it this far into the call and no one said the word COVID, right? I don't know if that's because we're tired of it or just
I did at the beginning.
Okay, well, okay, right. So once, but I think what that highlights though is that all of these things that were being described before were happening before COVID. This focus on in the environments, these questions that governments are wrestling with, the lack of capex investment because oil prices were volatile. This was all happening. And so I think what COVID is doing has accelerated some of that, but I think there's one area in particular that COVID has surfaced, and that's the H part in HSE. So as someone who has worked in the field, you're always told safety is number one. We all want to go home and see our families, so anyone can stop the job. And that's something very tangible and easy for operators to say, right? We all want to go home safely. Environment is the same. It's very easy to say we want to be good stewards of the environment, and you can show pictures and you can sort of say, well, we've done this, we've done that to help the environment. But the health part is much harder to get your head around. That was the case until COVID came. And so now if you look at in the COVID environment that we're in, even going out probably another 18 months, 2 years, maybe even further than that, because people want to keep being cautious. Like, how do you keep your workers and your employees safe? What does that new office space look like? What is the offshore rig look like where we're all in a very confined environment? I mean, what does that look like? And figuring that out and then implementing those changes, that's going to be very difficult and very costly. So I think that's the first thing. The second thing, again, is going back to this theme of things that were happening pre-COVID, and that's the recruitment within the oil and gas industry. So just very quickly, I think everyone on the call or on the video call has heard of the Great Crew Change, but the very quick summary is that as oil activity and prices are cyclical, so is hiring. So about 10 years ago, there was a big worry that all of the senior professionals would leave. There would only be junior professionals left, and so there would be no one there to kind of carry that baton. It seems like the industry got over that, but what we're maybe anticipating going forward is what we're trying to call the green crew change. So if you talk to younger professionals or maybe people just starting their university studies, what do you think of oil and gas? My hypothesis would be it wouldn't be that great, right? Because I mean, fine, you get paid well, you might get to see the world, but maybe not the best steward of the environment, and that doesn't line up with my values. So you have to, as an operator, as a service company, make a real effort to reach out to these new students, these new engineers, these new field technicians, because otherwise in 10, 20 years time, you're not going to be left with very many other with these established professionals. And I think the one thing I would add too, just before I turn it back over, Michael, is that going back to Lyle's point about CapEx being cut, you can show you're a good steward of the environment, but young people also get excited about R&D, fun technology, new projects. And if you cut this R&D, you're not just hurting yourself commercially because you have less products and services to sell. You're lacking things that you can then tell these new students in the recruiting presentation. So all of this is definitely tying together and makes for a challenge to think about for operators and service companies.
Well, thank you, David. I want to thank all the panelists. For those listening to the video or you're interested in more details about our perspectives on key issues for the upcoming year, please click on the link. And thank you very much for your time. We appreciate you listening. Bye-bye.